Today, we're talking about a concept that has completely taken over the financial YouTube space lately. If you've been researching retirement strategies online, you've heard about the new math of Roth conversions. Specifically, people are talking about a concept that has been popularized by Vanguard called the break-even tax rate, or BETR for short. If you're nearing retirement and have built a nest egg between $500,000 and $5 million, understanding this concept is critical. But before I get started, I'm George Jameson, a CFP, RICP, and founder of Capital Wealth Group in Columbia, South Carolina. Thank you for joining me. What I want to do today is explain what this BETR formula actually means in plain English, and then tell you why the advanced planning software we use takes this concept 10 steps further. For years, the golden rule of tax planning was incredibly simple. You were told to only convert your pre-tax accounts, like a traditional IRA, to a Roth IRA if you believed your tax rate in the future would be higher than it is today. If you thought your taxes were going to drop in the future, the old advice said you should absolutely skip the conversion. But Vanguard's research completely flipped the script by introducing the break-even tax rate. So the BETR framework proves that a Roth conversion can actually make you wealthier over your lifetime, even if your tax rate drops in the future. How is that possible? It all comes down to where you get the money to pay the tax bill on the conversion. If you pay the conversion taxes by withholding money directly from your IRA, the old rule of thumb is generally correct. You are shrinking your retirement account to pay the IRS, so you need a higher future tax rate to make the math work. But if you're like many of the clients we work with, you likely have cash reserves or a taxable brokerage account outside of your retirement funds. When you use those outside taxable dollars to pay the conversion taxes, the entire mathematical equation changes. You are effectively taking money from a taxable environment where it creates a tax drag every single year and using it to buy a tax-free environment for your IRA funds. Because you pay the tax with outside money, you allow the full balance of your IRA to move into the Roth and to grow completely untouched. Because of this wealth shift, your break-even tax rate drops significantly. Let's look at a simple example so you can see this clearly. Imagine you are actually in your peak earning years and sitting in the 32% marginal tax bracket. You plan to retire soon, and you expect your income to drop, putting you in the 24% tax bracket in retirement. So under the old math, you would look at this and say you shouldn't convert because your taxes are going down from 32 to 24%. But let's apply the new math. If you do a $100,000 Roth conversion, you owe roughly $32,000 in taxes today. Instead of taking that money from your retirement account, you pay using cash from your savings. By paying the tax with outside funds, Vanguard's formula calculates that your actual break-even tax rate drops from 32% all the way down to around 22%. Now compare that new break-even rate of 22% to your expected retirement tax rate of 24%. Suddenly, your future tax rate of 24% is actually higher than your break-even rate of 22. The math flips, and doing the conversion now creates more total after-tax wealth for you over the long run. That is the concept everyone is talking about online, and it is a fantastic starting point. But here is the reality of real-world financial planning. A simple algebraic formula is not enough to base your life savings on. While the BETR concept is brilliant in theory, real-world taxes are messy, and your life doesn't fit neatly into a single equation. That is why at Capital Wealth Group, I use advanced planning software like Right Capital, Income Lab, and Alista Plan, as well as run yearly conversions by one of the CPAs in my office. All of these planning softwares are built on the exact same underlying philosophy as Vanguard's new math, but they calculate the reality of your specific life. Instead of just comparing this year's marginal tax bracket to next year's, the software runs dynamic multi-year projections of your entire financial picture. First, it focuses on total lifetime wealth. It models exactly what happens when we deplete your taxable brokerage account to pay the IRS today. And it measures that depleted cash balance against the massive tax-free growth of your Roth over the next 30 years. If doing a conversion today leaves you with $3 million in after-tax wealth at age 90 versus $2.5 million without the conversion, the software proves the strategy may work. And then second, the software calculates all the nasty ripple effects that a simple formula misses. Vanguard's concept is great, but it doesn't automatically account for stealth taxes and other scenarios. Income Lab and Right Capital calculate future Medicare IRMAA surcharges and based on expenses, when you need the money, etc. They also factor in the exact taxation of your Social Security benefits based on your provisional income. They also calculate the massive spike in your income that will happen when required minimum distributions, or RMDs, kick in later in life. And finally, and perhaps most importantly, the software uses precision bracket filling. Instead of just telling us yes or no to a conversion, these tools calculate the exact dollar amount we should convert each year. The software might tell me to convert exactly $42,500 this year, so you max out the 24% bracket without spilling a single dollar into the 32% bracket. It ensures we don't accidentally trigger the next tier of Medicare premiums by converting just $1 too much. And then at Capital Wealth, we take it a step further and have a CPA review annual conversions to double check the math, because softwares aren't always accurate either. So while the YouTube videos are right that the math on Roth conversions has changed, you need more than a basic calculator to make this decision. You need a dynamic, personalized plan that looks at your entire financial picture, including where your cash is located and how all the moving parts will impact your specific retirement. That is exactly what we do for our clients, doing the heavy lifting of running thousands of variables to find the exact mathematical sweet spot for you. And one last thing, just because it makes mathematical sense doesn't mean it's always the right thing to do for you. That's it for today. Thanks for joining me on your Retirement Guide. Again, I'm George Jameson. I'm the founder of a fee-only firm. We offer ongoing retirement planning and investment management, as well as one-time financial plans for DIYers. If you'd like to take the next step, schedule a free consultation at our website, capitalwealthgroupsc.com. And if you found this helpful, please subscribe and share your thoughts in the comments. Have a great day.